along, ladies and gentlemen. I'm Hila Datia. We have with us Mr. V. Ramachandran, Director and CEO, along with Mr. Sudarshan Kasturi, Senior VP and CFO Finance and Accounts Department at V-Card Industries, joining in. Welcome to the show, gentlemen. My first question coming to you overall is, if you see in terms of the last quarter numbers as well, good growth that we've seen already, how would you actually describe FY22 as a year and the last quarter? Has it met your internal expectations?
Sudarshan, I'll take this.
Yeah, please.
Yeah. So I think broadly, we are quite happy with how we have done overall in FY22. I think if you will see, mainly, we've been a bit squeezed in categories which are summer dependent, as the first quarter of the year was challenging because of the COVID onset in May last year. So the current year, Jan Feb was close to start because most of the summer categories there was very high inventory as an overhang of the poor season of last year. So consequently, I think in that context, I think our performance was quite strong for the year, given that we had inventory overhang in summer categories, and broadly, I think summer categories we've been flat. Yeah. So in that context, I would say that of course we have partly benefited from pricing growth. Yeah, and I think there are categories like water heater where the year before we had supply challenges, and we were able to recover them in the current year. So I think that would be a balanced view of how we did.
Just to add one point to it, right now, what will really stand out if we look at the year in retrospect? Okay. Not in a positive way, but one big call out of it is the kind of commodity inflation that we have seen. To an extent, not seen in the recent history of many years. Under that context, where costs and margins were a big challenge, under those circumstances, we're pretty happy with the overall performance. Volumes have still come through despite the kind of cost increases that have happened. Yes, some bit of margin had to be given up. But sort of all put together in substance, under difficult circumstances, it's been a very good year.
Right. So overall, as you also mentioned in terms of the costs, that has escalated for majority of the companies on the back of higher commodity prices. Overall, if you see, around 28% is the kind of jump that we've seen. Do you think these cost challenges is something which is here to stay, or do you think it will ease out and we could come back to in terms of good margin growth?
Yeah. See, the commodities tend to go up and down over a cycle of a few years. Right? Sometimes when that volatility happens, it happens very sharp, in a very sharp way in a short time. This is perhaps one of those. If we look at some of the past cycles, what we also realize is the spikes are becoming sharper and more volatile. So perhaps we have gone through that. Yeah. It is not likely that they will stay elevated at this forever. It has to come down. But we've been waiting for commodity costs to moderate, but it's been going on for a few quarters. As we look at it now, it seems to have plateaued at least. So which is sort of a good sign. We should expect them to come down somewhat.
Right. So overall, if you see in terms of product pricing as well, what's the quantum of price hikes that we've taken in FY22 as a whole?
On a blended basis, our prices have gone up by about 12 to 14%. It varies across different categories, but at a company level, we have seen price growth of about 12 to 14%.
Okay. And overall, if you see in terms of the coming year as well that we are in, are we anticipating any further price hikes to compress the margin pressures?
We still have some pricing gap to catch up. In the year that passed, commodity prices kept going up, all 4 quarters. Pricing has lagged to some extent, and we can see the impact on margins. The margin gap essentially arises from the ability to pass on, or the lag between the pricing action and the cost increase. So there is some bit of gaps to cover up, especially in certain select categories. So we will see some pricing actions in those.
Right. And overall, if you see in terms of different product segments as well, where is it that we have seen, higher traction if you have to divide it between electricals to consumer durables and the other segments that we are in?
Ram, you can take that.
Yeah, I think we've had strong growth in consumer durables. I think even electricals we have witnessed strong growth. I think I would segment it more as products that are summer dependent and non. So if you look at for example stabilizer would have been flat to 4 to 5% growth. Inverter battery would have been flat. Air cooler would have been flat. Yeah, so these are all categories, which see strong traction in a short, window, right? So something like fan is also a summer-driven category, but still has a more flatter demand around the year. Okay, bit more than these categories. Yeah, so I would rather put it that summer-driven categories we've got were flat and that's really pulled down. Otherwise, I think remaining categories across the board we have had very strong growth.
Right. And going ahead as well, which are the segments which will actually fetch us growth over the next 2 quarters?
So I think we've had a strong start this year. From middle of March, for summer categories. Yeah, fundamentally because summer has been strong. Yeah, so I think we are looking to cover some lost ground in some of these categories and try to post more than normal growth in these categories as we recover the lost ground over the last.
Okay.
So I think those are categories I think we should see them doing well. I think broadly consumer durables we should continue to grow faster. See, as a company, right, we have last 3 to 4 years with a lot of disruption in the market because of GST, demon, and then almost COVID has interrupted more than years now. Yeah, in fact I would say COVID impact is spread over 3 years actually, because the last quarter of the first year, right, which is when COVID started, was also impacted. So I think but this period we have significantly focused internally on building our product capability, right, whether be it manufacturing or be it product development. Yeah, so I think the coming period should be a time when we should start to benefit from the effort that we have taken in the recent past. Yeah? So I expect, I think we should do better in consumer durables as a category because of the work that we have done on the product development side. I think summer categories should also positively do well. Yeah, I think we continue to focus on expanding our reach and availability for switches and switch gears, which are categories that we recently participated. So I think it will be reasonably broad based is what I'm expecting. Therefore,
right. So overall, if you have to divide it in terms of regions as well, 58% does come in from the south. How is the north and the west region performing?
So I think last year also the non-south has performed better, right? When you look at for the year, right, the non-south has performed better than south. Yeah. So I think we continue to grow our business in non-south. Yeah. And I believe we are well on course to increase our share of non-south in the coming years, right, in line with our strategy and objective. Yeah.
Right. So what would that non-south share look like in terms of revenues over the next 2 to 3 years?
See, it's been going up by about, anywhere between 150 to 200 basis points year on year. So, it's currently reached about 42% of the total. I think we should continue the same trajectory, add about 2% every year.
Okay. And overall, if you go to see in terms of inventory as well, how is the inventory now at the company level? And secondly, with regards to the channel level as well, how is that looking like?
See, at a company level, the inventory position, the stock levels are a little higher than what they would normally be. coming out of COVID and the lessons learned from supply chain disruptions that we have gone through in the last 2 years, we sort of made a conscious call to keep additional inventory with us. The year before, if I were to recap, because of COVID-related shutdowns, we lost quite a bit of sales. I mean, there were no supplies of water heaters in the peak season and things like that. So to avoid a repeat of that kind, we have consciously built up and kept additional inventories through the year. I think now with things settling down and the chances of disruption are much less. The major risks have dissipated and we're actually bringing them back to normal. Channel inventories, Ram can comment.
Sure.
Channel inventories are normalized now, and they, as we entered into the season, I think in summer categories, channel inventory was still high. But I think with a strong summer, I think broadly, inventories have normalized, and probably in some of the summer categories, I think the channel inventory would be what I would say as quite efficient at this stage. Yeah.
Right. And overall, if you see in terms of expansion plans as well, what is our current capacity and capacity utilization on a blended basis?
Yeah, see, if you look at our overall capacity, we produce in-house about 60% of our total throughput. Okay. The remaining 40% is outsourced. And the strategy is very specific to categories. Right? So there are specific categories that we have a clear plan to bring more manufacturing in-house, and we are expanding capacities there. The existing plants are running quite stable at steady state. They will have 75-80% capacity utilization, and when they reach such a level, we then look for capacity expansions, like the case of wires, for example. Wire factories have been running pretty stable, and now time has come to expand existing capacity. There are other new plants that we have recently set up in the last 2 to 3 years, where capacity utilization may not be that high, but it's increasing year after year. So it will another year or two to get to steady state.
Right. So how much capacity expansion are we looking at?
See, the share of in-house manufacturing has increased from about 50% to currently 60%. So that's the kind of expansion we have done in the last few years. So the last 3 to 4 years. It can go up further. Maybe we will get to 65 or 70%.
Okay. And overall, if you see in terms of growth in terms of the expansion as well, how are we planning to fund it?
Yeah, funding it through internal accruals.
Okay.
The cash flows are strong enough to support the kind of Capex that is required. And one point I wanted to bring out is all these manufacturing Capex, which aims at either substituting imports or bringing in volumes in-house from OEMs, right? They are all margin accretive. So in terms of the asset productivity and whatever DCF yield and things like that, they are pretty good. So they can be very well funded from internal sources, and they really add to margins.
Right. And very lastly, overall, if you see in terms of growth, what's that strategy looking like from here on?
Ram?
Yeah. So I think I mentioned earlier, right? I think last 4 years, we have been last 4 to 5 years, we've been very strongly focused on improving our competitiveness. Yeah. Be it what I would say as product differentiation centric, which may be either design or feature or functionality, or cost centric, which is where we've been expanding our manufacturing footprint. Yeah, and we will therefore be able to be more competitive in terms of cost of goods. Yeah, so I think that's been our fundamental focus, and I think we are really looking at our improved competitiveness to be the single largest driver for improving our revenue. revenues. Beyond that, we are focusing on emerging channels, and we have been building strong internal capabilities, channels like e-commerce and all, where we are looking to expand and grow our business. Now, as far as GT is concerned, I think we continue to focus on expanding coverage, and adding more categories to some of our existing channel partners, right? So we have, let's say, a channel partner who's strong for, let's say, water heater, right? How can we get him to sell fan or air coolers and so on? So there is a lot of opportunity to what I would say, expand the retail footprint for our brand, both in terms of unique outlets that we are adding, as well as increasing the share of our product basket with existing customers. So these are going to be the fundamental drivers for as we go forward.
Right. And as you mentioned about general trade versus e-commerce as well, currently what's the breakup, and are you seeing higher traction in e-commerce? Do you think that share could increase?
So I think we have a basket of products as a portfolio, right? And some are today, like, we have categories like wires, switches, switchgear, pumps, right? Which are not on e-commerce or very nascent, right? So if we exclude them, right? And look at the remaining part of the portfolio, about 10% is coming, as a share of business is coming from e-commerce, right? We believe that, relatively, we are under-indexed in these categories. Relatively under-indexed in these categories. And we should be able to, grow our presence in these categories on e-commerce, right? As we get our, what I would say, offerings in place.
Absolutely. And I think the sector that you're in as well, I think post-COVID and during COVID, a lot of development in terms of real estate has picked up. And that's something which will be a positive for a sector like us as well, because people owning homes, construction work, all of that is going up. So I think a good space to be in at the right time as well. Thank you, Mr. Ramachandran. Thank you, Mr. Kasturi, so much for joining us on the show. A pleasure to speak to you. Congratulations once again for a good set of numbers in spite of all the headwinds that we have been facing, and good luck for the coming quarters as well. Speak to you soon again.
Thank you very much, and good speaking to you.
Thank you. Good speaking to you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.